Okay, I think you can see slides. I'm looking here on another device to see if all is well and all looks well. Great. So we are going to continue now with IAS 12. So we didn't finish everything we had to do last week, but that is okay. We have time to do it today. And I'm hoping you thought about and got comfortable with what we spoke about last time. But if not, hopefully you will become more comfortable with it now, and we will then sort of pick up and continue running. Okay, so today we will we'll look a little bit again at current tax. We basically covered everything on the current tax side last week. But I want us to look at what is the impact of assessed losses. Then deferred tax, we're going to look at recognition, including deferred tax assets and unused tax losses. We're going to look at measurement, presentation, and disclosure, which includes a tax recon. So it's quite a lot of work, but it's quite important for us to cover this because students often struggle with these things that we are doing today. So I wanted us to do most of the basics last week so that we can just digest it a little bit. And now we're going to do the stuff that people generally struggle with, but we are not going to struggle with it. We are going to smash it. Okay, so deferred tax recognition. So the standard addresses the scenario of when do you recognize a deferred tax liability and when do you recognize a deferred tax asset in different paragraphs, but the rule is similar but slightly different. So for deferred tax liability, now keep in mind that happens when you have a taxable temporary difference. Then you want to recognize a deferred tax liability, which means that your tax in future is expected to be more. Okay. And you always recognize it, which is quite interesting, right? If you look at what this paragraph says, paragraph 15, it says for all taxable temporary differences, except to the extent that the DT liability arises from initial recognition of goodwill. Oh my goodness, my power just came back. So we are going to switch now, but let's finish this slide. Initial recognition of goodwill or initial recognition of an asset or liability, okay, in a transaction in which is not a business combination and at the time of the transaction affects neither accounting profit or loss, okay, or taxable income. Okay, so it doesn't touch your profit, doesn't touch P&L, and it also doesn't touch taxable income when at the time of the transaction, which means at the time you initially recognize, do you see the initial recognition of an asset or liability? So that's quite important. As soon as you pass that first journal entry to bring it into your books, you need to ask yourself, as I pass this journal, are one of these legs of the journal hitting P&L? Okay. And you need to ask yourself, is taxable income affected today? Okay. Then also, it's all ands here. You see, if we're looking at this second bullet with its sub-bullets, these are all ands. So you must meet all of them. Okay. And at the time of the transaction does not give rise to equal taxable and deductible temporary differences. Okay. So they don't sort of offset each other. Does not. Affects neither. Okay, so it's a little bit of a weird story because we're working double negatives here. We will recognize it, but we will not recognize it with the except here. We will not recognize it if it relates to an asset liabilities initial recognition that's not a business combination, that doesn't affect accounting profit or taxable income at initial recognition, and also at initial recognition does not give rise to equal taxable and deductible temporary differences. That's a lot, but we are going to look at quite a few examples to explain it. On the asset side, okay, it starts the same for all deductible temporary differences, but then there's an extra step that isn't there for the deferred tax liability. And it says to the extent that it's probable that taxable income will be available against which the deductible temporary differences can be utilized. Okay, very important extra part, and we're going to come back to that a little bit more when we are going to look at the assessed losses. It's going to make a lot of more sense there. But do you see that there's an extra step here that we didn't see for the deferred tax liability? Okay, then it says unless. So again, we're saying we will not recognize a deferred tax asset if it arises from the initial recognition of an asset or liability, and we have the same storyline we had with the liability. Okay, so we are looking at the recognition exemption. And while we do that, give me a quick moment. Okay, just let me know if you can see again.
Yes.
Right, so let's see it come into action, what we just discussed. So these exemptions, right, that we just discussed, let's see it come into action. So if I say to you, land was acquired at a cost of 500,000, and obviously you can assume there are no capital allowances, but that you know. Okay, assume that the carrying amount of the land will be recovered through use, not sale. You're making assumptions now. We are going to actually go into depth into that now soon. Use versus sale. Okay, at initial recognition of land, you would have a taxable temporary difference on day one. Okay, you need to ask yourself what happened at the initial recognition of this asset, because that's what's going to ask us, or that's what's going to help us determine is it exempt from having a DT liability or not. So at initial recognition, we had our carrying amount, which was 500. The tax base is 0 because we'll have no future tax deductions, and we've assumed it's through use. Okay, just assume that for now, which means that we don't get anything through use, no allowances through use. Okay, gives me a taxable temporary difference of 500. Should I recognize a DT liability or not? Now we're going to test it. Our first question is accounting profit affected at initial recognition? Okay, that's our journal entry when we recognized it. Do you agree? No, it's not affected. You can see both of those hit SFP and neither of them hit P&L, which means accounting profit was not affected. Okay, was taxable income affected at initial recognition? No, we couldn't get a deduction on it. We couldn't get an 11A, it's capital in nature, and we definitely aren't getting any capital allowances. Okay, so the answer is no. So far we are leaning towards we want to exempt. We are so far allowed to apply the exemption. Okay, we need to ask one last question to just make sure. Okay, does it give rise to equal taxable and deductible temporary differences? Well, if we go back to the previous slide, it gave us only one, which was a taxable temporary difference. So there's no equal deductible temporary difference. Thus, it is exempt from you recognizing a DT liability. You see the steps you need to take. Okay, let's do we can continue here. Is exempt, thus no DT liability. Let's look at another example. Let's say I have research costs that are expensed for accounting purposes, but it's deductible for tax purposes at 25% per annum. Okay, and the research expenses amounted to 100,000. Okay, at the initial recognition, this is what we're sitting with. The carrying amount is 0 because it isn't even an asset. Okay, our tax base is going to be 100,000. We're going to deduct that over 4 years. Okay, because it's 25% per year, which gives me a deductible temporary difference of 100,000. Do I recognize a DT asset is the question. Well, does it affect P&L at initial recognition? That is my first journal. At initial recognition, I debited and expensed the research costs. Do you agree? Thus, it can't be exempt because it does affect the accounting profit at initial recognition. Okay, so you will recognize the DT asset to the extent it is probable that you'll have future taxable income. And we're going to go into that extent soon as well. Okay, but do you see sort of the thought process and the steps to apply the exemptions? Okay, ask yourself those questions. Okay, next one. Okay, assume they entered into this company entered into a lease agreement which gives rise to a lease liability of 250 and a right of use asset of 250. Because remember, in any case, in most cases under IFRS 16, your initial recognition will be the same given there's nothing else other than the liability and the right of use. We will still do IFRS 16, but for now, assume that those two entries are exactly the same. Okay, assume lease payments are deductible and are made annually in arrears, so deductible for tax purposes. So initial recognition of the lease liability. Okay, it's a liability. So, and a normal liability, it's not income in advance. So my tax base is my carrying amount less future tax deductions. Okay, and for an asset, now for the right of use side, the future economic benefits are taxable, thus it will be my future tax deductions. Okay, so my lease liability, carrying amount, right of use asset, that was given to us. On the lease liability side, we said carrying amount less future tax deductions. The carrying amount is 250 minus the 250 we will be deducting in future. It's going to take me to a 0. Okay, because it's deductible. Gives me a deductible temporary difference and the right of use asset. Okay, we can't claim capital allowances on the right of use asset because we don't own it. Okay, therefore, tax base is 0 because my future tax deductions are then 0. Thus, temporary difference is 250. Taxable, this one's deductible, the bottom one is taxable. Should I recognize DT asset and DT liability for each of them? First question, at initial recognition, is P&L affected? No. Okay, is taxable income affected at initial recognition? No, because the lease payments will only be deductible at the end of the year, once actually incurred. So not at initial recognition. Do you see that? Okay, and furthermore, I can't claim anything on the right of use asset. Can't claim an 11A today, I can't claim it later, and I can't claim capital allowances. So no. So far we want to. Now, do I have equal taxable temporary difference and deductible temporary differences? Yes. Thus, we need to recognize the deferred tax asset and the deferred tax liability. Do you see the answer had to be no? Okay, because it says gives rise to neither taxable nor deductible, or gives rise to, or does not give rise to equal taxable and deductible temporary differences. Okay, and they're equal. Do you see that? Okay, so you recognize it. Okay. Cool. Let's do a very quick example, just covering quite a few things we've covered. Okay. Assume at 31 December we have the following carrying amounts: land, plant, patent, inventory, provision for dismantling, given to you there, and other information. Land will be recovered through use, not sale. Assume that for now. Okay, no capital allowance is claimed on the land. We know that. Here they say to us the plant qualifies for capital allowances amounting to 10 million. Yeah, it's heavy, ne? 10 million per annum and was acquired on 1 Jan 2024 at a cost of 60. Okay, patent qualifies for capital allowance of 400 per annum and was acquired on 1 Jan 2024 at a cost of 8. And the balance, the opening balance for the DT liability is 1 million. Okay, so let's work through it. For the land, we said it's going to be recovered through use. Okay, no capital allowances are claimed, so my tax base is what? It's an asset. My future economic benefits will be taxable. Remember the little diagram. Therefore, future tax deductions will be my tax base. That is 0. Okay, gives me a temporary difference. However, it is exempt. Why? Because we considered it and said at initial recognition, it's pretty much the example we did first with these exemptions. Okay, we considered it and we said at initial recognition, does it affect accounting profit? No. Does it affect taxable income? No. Does it give rise to equal taxable and deductible temporary differences? No. Thus, it is exempt. Okay, for the plant, Okay. Tax base for the plant, if you think about it, it is an asset, right? Tax base for an asset, we need to ask ourselves, are future economic benefits taxable or not? Yes, they are, because the plant is going to produce inventory and we are going to sell it. So it will be my future tax deductions, will be my tax base. Okay, what would that be? They told us you get 10 mil per annum. Okay, we already bought it at the beginning of last year. So we claimed for 2024 and we claimed for 2025. Okay, and that's the total cost. So cost minus allowances claimed already means this is what's still left to claim. That gives me a taxable temporary difference, and I'm going to apply the 27% to that. Okay, for the patent, okay, again, it's an asset, future economic benefits taxable. They gave us the allowances also acquired at the beginning of last year. That's the cost minus the capital allowances already claimed, gives me my future tax deductions. Okay, thus that gives me a deductible temporary difference times 27% gives me the DT asset I want to recognize on it. Okay, inventory. Tax base here is the full amount. Can someone tell me why? Why is the tax base equal to the carrying amount?
Because there are no allowances on inventory.
No capital allowances, but there are deductions. We'll actually in tax be doing the inventory side of things, the detail. Okay. First question you ask in determining a tax base for an asset is, are future economic benefits taxable? Answer is yes, right? I'm going to sell the inventory and I will be taxed when I sell it. You agree?
Yes.
Great. So that means my tax base for my inventory is my future tax deductions, which will be the cost of the inventory. Okay, because normally how it works, and we will do inventory, but just as a very brief recap, you would claim an 11A on the date you buy the inventory. However, at the end of the year, Section 22 will ask you to add it back if it is unsold. Your closing inventory will add back. So you've effectively deducted nothing in the year that you bought it and did not sell it. But at the beginning of next year, Section 22 will allow you to deduct it again. You see, so next year I'm going to get a 22.2 deduction on this inventory at the same amount, which is the cost. Okay, cool. So therefore, it doesn't give rise to a temporary difference. We are actually in alignment, and it shouldn't. That is the point of Section 22, is we want to align a little bit more to the accrual system. Even though it is tax that doesn't like the accrual system, inventory is one of the few places that tax actually wants to agree with accounting. Mostly, they still don't agree, but we will get into that detail in the tax lecture a little bit later when we do trading stock. Okay, cool. Then the provision is a liability. Is it income in advance or is it a normal liability? It is a normal liability. What is my tax base for normal liability?
Zero.
Automatically
Carrying
zero,
amount.
yes. Carrying amount less.
Amount
Future
deductible.
tax, correct. Future tax deductions, perfect, which gives you the zero. So correct. Okay, gives me a deductible temporary difference times 27%. There we are. Okay, that gives me a DT liability at the date there should be 2025. Okay. Movement they gave us prior year, that's my balance. Remember, this is a balance that you get here. Okay, movement gives me my balance. Balance less balance gives me an increase, so I need to pass a journal. Again, I must say 2025. There I create or recognize or rather increase my DT liability from last year, because my balance last year was 1 million. I need to take it up to 1.2. So the difference I'm going to credit, it's a liability, and I'm going to debit income tax expense with that deferred tax expense. Happy? Okay, Ronald.
Hi, teacher, can you hear me? Okay.
Yes.
I'm lost because when I joined the class, you were talking about a deferred tax recognition. Then later now we're looking at whether a future tax if the carrying amount, or if, let's say example, the inventory are the future economics that deducted in the future. So the whole thing just made me confused, because there's a part when we're focused on the on a recognition method where we're looking at a P&L, and so that whole part just confused me.
Okay. Okay, I'm with you. So technically, right? So technically what we're supposed to do, so what I did now was I started with looking at when do you recognize it? When can you pass a journal? And the answer for a liability is always, okay, except if the recognition exemption is met. For an DT asset, the answer is always, but to the extent of taxable temporary differences, and the recognition exemption must also not be met before you recognize it. So that's the thought on around the recognition exemption. So technically, right, you actually, for each of these items, had to consider if the recognition exemption applies. Okay, so we didn't now go into depth and do that for each one, but technically you have to think about it every single time. Okay, and the answer for each of those ones, except for land. Land is the one that would have been yes, it is exempt. For the rest, it would not have been exempt. Okay, I just used about 3 examples to explain the exemption, but then I wanted us to sort of just do an overall, just think about how would we do the deferred tax calc, thinking about the exemption where it applies, which is in land in this case, but for the rest, let's just remember and remind ourselves about what the tax base is. So remember last week we did the tax bases, quite a lot of it. So I'm borrowing from last week's lecture where we were talking about the tax base. So for inventory, now we are looking at the tax base. You see, so that tax base step you do before you even think about the recognition exemption, actually. Okay, so first what you need to do when you're looking at each of these items is to first determine if there even is a taxable or deductible temporary difference. So first calculate the carrying amount, calculate the tax base, which will then mean that you calculate the temporary difference. Then you need to ask yourself, is it exempt or not? By applying the steps we did in the previous examples. Okay. If it is exempt, then you do what we did here for land, where you don't multiply there by any tax rate. You say they're exempt and it doesn't add to the total balance. Do you see? If it is not exempt, that means you must recognize it, right? In which case, that's what we did for the remainder of the items. You see? Now, I'm showing you the next step with this comprehensive example. Now we add up all of those balances, or each item's DT balance, which gives me an overall liability or asset balance. In this case, we end up in a liability position of 1223661. Okay. Then I must say, well, this is my new balance at the end of the year. Okay. I now need to then get my balance to be there. And in the example, we said, listen, the DT liability balance, opening balance was 1 million. I need to now take it to 1.2. So I need to get the movement to see, okay, I need to increase it from 1 million to 1.2. So I will pass a journal that does that. Do you see that? Are you a little bit more with me?
Yeah, I am.
Okay, cool. I want us now to first think, yes, linear.
Yes, DJ.
Yes.
Hello.
Do you
Okay.
go by, how do I say it again? It's
Linear scale, linear equation. So it's
linear
easier to
equation,
remember when,
linear
yes,
scale.
it's
Yes,
it.
I remember.
Okay. So I'm sorry to take you back, but so when we did current taxes last week, right? we're trying to determine our current tax by working from our profit before tax and then
Correct.
to our taxable income, and then we apply the tax rate to get our current tax. But now I know that, let's say if I'm doing assets where it's depreciation and tax allowance, there will be like a temporary, like that difference between the carrying amount and the tax base. That one I get. But what's confusing me now is when we do deferred tax now, is it like we have different transactions where we have to determine the tax base and the carrying amount for each of these transactions to then calculate our temporary difference, apply the tax rate, and then get the deferred tax? I don't know if I'm mixing it up, but can you just explain? I just
so
need a flow. Yeah.
yeah, let me give you the flow.
Okay.
So the flow is you will first always do your current tax calculation. Do that first before you even go even close to deferred tax. As you described correctly, we start, and here's even an example up on the screen now. We start with profit before tax and we make our adjustments for the differences to get to taxable income. Then you multiply your taxable income with your tax rate, which is 27%. That gives you your normal tax liability, which is your current tax expense. You pass a journal. You debit income tax expense and you credit current tax payable. Done. That's your journal. Now you go on to deferred tax. Okay. Now you need to consider the deferred tax consequences. What you then do is you ask yourself, which items, now we are doing deferred tax, you see, which items, or rather, which assets and liabilities do I have? And for each and every asset and liability, you put in the carrying amount, which is easy because you've already done all of that. Okay, maybe in a question paper, we're going to give you something where you might have to still calculate it a little bit. Okay, but normally you would have already done all of that. You just pop the carrying amount at the end of the year in there, at the end of the year. Okay, then you ask for each asset and liability, you determine the tax base. Then, by following the diagrams we did last week, then you get your temporary difference. And then you ask yourself, is it exempt or not? Okay, if it's exempt, you won't recognize any DT asset or liability. If not, you recognize it. Okay. And then you will get this balance, which is your closing balance for deferred tax, which may be an asset or a liability. And then you ask yourself, what was the balance last year? And what must it be now? Well, the balance now I've calculated as the total of all of these numbers should be 1.2. Now I get my movement and I pass my second journal, which is my deferred tax journal. But can I tell you what we're doing is going to maybe clarify everything soon. What we're doing now is I am going to, just to give a bit of context, now we've done this deferred tax basics. I want us then to just look on the current tax side at an assessed loss, because we didn't do that last week. I wanted to just digest the current tax. Then we're going to go into the deferred tax for the deferred tax asset, as well as on the assessed loss. It's best explained with an assessed loss. Okay. And we will also then look at the tax rate that you need to use in your deferred tax, because that comes from measurement. So it's basically the measurement of your deferred tax. And then at the end, we're going to do everything in one example. Current tax and deferred tax with losses, with a recon, with everything, which will then maybe give you that flow a bit better. I just want us to do things piece by piece before we get all the way to the end.
All right. Thank you.
Okay.
But at least
So
now
maybe
it makes sense a bit.
does it make sense now as well?
Yeah, I was so confused. I was
Okay.
Thank you.
Okay. Okay, cool. But we will do a full example that's going to do current tax and deferred tax in full at the end, once we've covered everything, because that's going to test everything and it's going to cover everything you need to know, which is nice. Well, pretty much everything you need to know is going to be in there, but the tuts will elevate it a bit in terms of difficulty, but the example is going to cover everything you need to know. That doesn't mean you must leave and ask your friend, let me know when he does that example. Okay, because we need to get there. Okay. So on the assessed losses side, I'm giving you this example saying that someone has started the current tax calculation, but they don't know what to do with the assessed loss story. So we didn't do that last week either. I want us to do it now. The adjustments were simple, but now I want us to think about what happens if I have an assessed loss from last year. Now, what does Section 20 of the Income Tax Act say today? Anyone want to give it a go? I think you have. Have you done all of your assessed losses? I think you did your assessed losses with Edwin. Did you?
Not yet. I think it's this week.
Is it this week?
Yeah,
Okay.
fine.
Section
That
20
is
says the assessed loss can be ring-fenced.
Okay, that's one of them. Ring fenced, but we're thinking about ring fencing for an individual. What does it say for a company? There's also a bit of ring fencing with foreign income. If I say to you, I had an assessed loss last year, what does Section 20 say a company can do with last year's assessed loss?
Isn't it to utilize it against the current year's taxable, limited to the current year's taxable income?
It can.
Yes, we're getting there. We're getting there. So Edwin will maybe take you through it in a little bit more depth this
the
week.
higher of $1 million or 80% of the taxable income, something like that.
Perfect. That is the answer. Okay, so Edwin will take you through the detail, but what you need to know from a FINAC side, and we will not tell that to you, you must know it, but it's easy, is that the assessed loss from last year that you are carrying forward to this year is limited to the higher of 80% of your taxable income before the assessed loss and 1 million. Okay, and the difference between the amount, if you've limited it, and the actual assessed loss, the difference between that can be carried forward again. Okay, but Edwin will go into the depth there, and he's probably going to open the ledge for you. Okay, and you're going to get into the depth, but that is sort of the crux. So we're going to do that now here in accounting a little bit. Okay, so if I say to you here, this person has done the calculation up until this point, okay, and they said to you, last year when I did my current tax calculation, when I did my normal tax calculation, I ended up in a minus 7 million. Thus, I ended up in an assessed loss position, okay, of 7 million. As we said, that 7 million can be brought forward to this year, which is now, that was 2024, 7 million. Now we are bringing the 7 million to 2025, right? But it is limited to the higher of 80% of the taxable income before the assessed loss and 1 million. Okay, so let's look at that here. So I have the 7, and it is limited to the greater of these two amounts. 1 million and 80% of the taxable income before the assessed loss. Which one is, now look at it, of the 1 million and the 32.4 million, the higher is 32.4, which is my limit. Do you see that the loss is 7, which is less than the 32? You can only use what you have. I only have 7 million. You agree? I can't manufacture a new loss. So my limit is sky high. I'm actually not limited then. I can use all of the 7 million. Do you see that? Are you with me? Okay. which I utilize. Then I get my taxable income final. And now I multiply that by 27%, which gives me my normal tax liability. That is also my current tax expense. I'm going to debit income tax expense with 9 million, and I'm going to credit current tax payable with the same amount. Okay, are you happy with how to work in the assessed loss here? Okay, the next question is, what if I can carry it forward next year? Is that not then an asset to me from an accounting perspective? So remember, we just said in 2024 here, last year, last financial year, we had 7 million, right? That I knew is going to look at what the 7 million is doing this year. It's reducing my tax. So at the end of 2024, I had this 7 million that I know is going to go and reduce my tax next year by 7 million times 27%. Is that not then an asset to me? Are you with me on that thought process? At the end of 2024, I had an asset of 7 million times 27% because my tax is going to be chopped by that amount. So should I not then recognize an asset, a tax asset, in fact, a deferred tax asset for the 7 million? I should, right? That's what I am expecting. It's a benefit. So surely I can then say to my users, listen, we got money coming. We're going to reduce our tax next year. It was a tough year this year. We have a 7 million loss, tax loss, but we know that next year it's going to help us. Okay. Linear? You're still good.
No, sorry. I raised my hand long time.
From earlier. Okay.
Yeah.
Okay. You go.
Hi, sir. About carrying the assessed loss forward and creating the now theoretical deferred tax asset. For me, I want to challenge it because wouldn't you only know like reliably the amount of the deduction paid when you do the test to now see if it lands between the limit of now 1 million or 80% of the current year-end taxable income?
Oh, so you're saying, you're saying the problem arises now that I said I want to recognize a deferred tax asset related to the 7 million, but the problem arises on, I don't know what the limit is going to be next year yet. Is that sort of where your challenge is coming?
Yeah, because you're not, when you end the year, in the previous year, you're unsure about what your future taxable income will be at the end of the next period now.
And that is a very important point, which is part of the definition, or not definition, of the recognition criteria of a deferred tax asset. That's part of the problem. If I say to you, I am pretty sure, it's questionable, but if I say to you, I am pretty sure I will be profitable within the next few years. Next year will be good. The year after will be good. It might not be 7 million opposite good. You know, maybe I don't even make enough. Maybe I only made taxable income of 1 million.
Yeah.
Right? But that's next year. What about the year after? What about the year after that? Eventually, I'm going to use all 7 million if I am pretty sure about my profitability in future.
Okay. So if you
see-
can ensure you'll be a going concern, then you can still.
Essentially, the criteria is a little bit different for IAS 12, but even if I am not very profitable next year, only a little bit, but the year after I make a little bit more, I'm going to continue to use the 7 million as I go along. It's just going to be spread over a couple of years, right? Could be.
Yeah, so then that would just create now a temporary difference in the timing of the whole of using up the assessed loss.
Yes, but the asset that I'm reflecting should effectively just be the 7 million times 27%. Depends. You're going to see now,
Can you use up that asset?
even though it's going to be over a number of years, because a deferred tax asset in any event is a non-current asset always.
Okay, so no, I get it
See.
now. So
But you are raising the most important point that I want us to look at, because that is the whole sort of point around, okay, recognizing a DT asset. Okay, and it's very important. So remember we said when we were looking at the recognition criteria, with the exemption at the bottom, but we said for DT liability, we said you always, for all of them, you recognize, except if it is exempt. For an asset, a DT asset, we said, I actually think I have another, okay, now I have too many questions here now. But for the DT asset, we said, listen, you're going to recognize it for all deductible temporary differences as well as an unused tax loss. Okay. And we had the same exemption, but we had one extra step for a DT asset. And that was that you can recognize it to the extent that you'll have, or to the extent that it is probable that you'll have sufficient taxable income in future. And that is what we're looking at now. I want us to look at that. So you'll see here that, great, it's going to be reductions in tax payments, but inherent in an asset that that I hammered on last week was to say that what is an asset? It is future economic benefits. So what is the economic benefit then of a deferred tax asset? It is going to reduce your tax. But what if there's nothing to reduce? Then you can't get this benefit. Do you agree with that? If I don't have any income to deduct this from, the deduction is useless. I will never get the deduction. If I'm sitting in an assessed loss position forever and I go out of business, I'm never going to get the benefit of the assessed loss. SARS is not going to pay me that money back. It's an assessed loss and it goes away. You close up shop and you lose it. So you'll only get the benefit from that assessed loss or these deductions, these future tax deductions, if I have income to deduct it from. Do you agree?
hi sir, sorry to jump in, but
Sure.
I just want to ask what the factors were that would now, I guess, hinder the probability of the entity now.
That is a very, very good question. The standard writes quite a couple paragraphs on, what may make it more probable and less probable. We will not sort of test that because that is a little bit more tough, but there's quite a few things you could take and think about. Budgets, you could actually look at your profit history. There's a lot of actual factors that you could take into account to make that assessment, and the standard actually gives guidance as to what should help you with what is probable and what is not. However, we will tell you what the company has assessed as at the end. We will tell you whether they are certain, not certain, whether it is probable or not. We're going to drop a line in the scenario that will tell you that. So we won't expect you to make that assessment, but it is a tough one practically to make. In practice, it's more difficult. Okay. Are you with me?
Okay, yeah, no, I'm with you, sir. And just to make sure, so if it's stated that it's not probable, we can't use this, we can't utilize this as loss.
Now I'm going to show you where we're going to go if that's the case and if it is not the case. I'm going to walk you through it now. Okay, great.
No problem.
So, as I said, your future economic benefits will only come to you if there is something to deduct it from. So if you don't think there's anything to deduct it from, could you say that there is an asset? You can't say there's an asset. Do you agree? But maybe there is a little bit of an asset and not the whole asset. And that's what the standard says. Okay, so here they address only if it earns sufficient taxable, but this is the question you must ask yourself, and it is going to give you the answer. If it is probable there will be sufficient future taxable income, as at the end of this year, when you're looking forward now, then you can recognize all of it. If you think you're going to make money, you recognize it, you times 27%, you call it a day, and you recognize all of it. If it's not probable, you can actually still recognize the asset, but to the extent of taxable temporary differences, which means that your DT asset will be limited to the sort of DT liabilities that came before it. Eventually, your result of the second bullet is that you will have a net DT asset / liability of 0. You will take it down to 0. So you will not have a DT liability, but you will also not have an asset. You can't have an asset in your books overall if you don't think you're going to have enough money to actually get all the benefit of the asset. Because remember, I said you can only get the use of the deduction or the assessed loss if there's something to deduct it against. So you can then recognize the deferred tax asset to the extent of the taxable temporary difference, the thing you will deduct it against. Do you see? So you're going to limit it to what future taxes that you expect. You're going to nullify it, reduce that to 0, because at least you expect those future those incomes that will be taxable. But that's as far as you can go, because if you don't expect to have anything more than that, you can only go to as far as you can prove it. Okay, we're going to do a quick, very brief example here. Okay, at the end 31 December 2024, I've given you now plant and provision here. Okay, we have a taxable temporary difference of $1 million from the plant and a deductible temporary difference from the provision. Do you see that the deductible temporary difference is much higher, okay, than the taxable one? So what would normally have happened here? Okay, I would have multiplied both of them by 27%. So for the plant, I would have had the 270, and for the provision, I would have had the tax effect of that deductible temporary difference of 4.6 is 1.26. Okay, which would have given me a net deferred tax asset of 990,000. Okay, I want to do that, but we just established you must first ask yourself a question. Well, is it probable that future taxable income will be available against which the deductible temporary difference can be offset? If the answer is yes, you can recognize the 990 netto, or the full 1.2, you will recognize all of it, which will take you to a total 990. If not, we will limit. So let's see what happens. If I say to you, with the same example, if I say to you it is probable, the scenario will be, okay, my little slides are moving. We looked at this on the previous one. This would have been your scenario. Okay, you'd recognize all of it if it is probable. What if it's not? What would it look like? Okay, all of that's still the same. But now I must limit it to my taxable temporary differences. So instead of recognizing the 1.26, I can only recognize 270 of that amount. I must limit it to my taxable temporary differences. Do you see? It must equal that amount. Do you see? Which takes me to a net of 0. Happy. And that means I have an unrecognized portion, okay, of that asset. Remember, I wanted to recognize 1,260,339. I only recognize 270, which means there's a piece of this that I did not pass a journal for. I will now pass a journal for nothing. I'll debit income tax expense with 0, and I'll credit deferred tax liability with 0, because my movement from, or rather my balance must go to 0. So if my balance last year was something, I must bring it down. That's one option. If I didn't have a balance last year and I don't have a balance this year, then it is 0. Okay. Okay. I think you go. Are you good? Previous hand, new hand.
No, I think it's an old hand, so.
Old hand. Okay,
Yeah,
great.
but I did have a slight, but someone did have their hand up before me. I think it was Tola. Oh.
Okay.
Hi, DJ. I just want to
Yes.
ask with what you just said, right? He's saying if last year we had no deferred tax, it's going to be 0. But if we did, it's going to be 0 with the movement. Like, sorry, we're going to
So
decrease with the 270.
it's simple. Simple. I think I may be confused with scenarios, so let me maybe make it just a bit clearer. Our balance now is 0. You agree? Now we still need to pass a journal for the movement. Meaning I compare last year's balance with this year's balance. Last year's balance is whatever it was. This year's balance is 0. Do you see? I need to then just make sure I get my balance to 0. Fine.
The movement or the deferred tax as a whole.
The movement in my deferred tax liability balance. So if I said to you at the end of 2023, my balance was a liability, my overall balance, this number here for last year's calculation, 2023, was 1 million. And I say to you now, you can see the balance is 0. That means my liability needs to go from 1 million to 0. Do you see that?
Just a quick one. I get that, right? Let's say.
Then I pass a journal.
Let's say, for instance, right now, this this deferred tax, the plant, right? Let's say the plant was a million, right? And the provision was that like would also cap it to 1 million because we can't do over. What am I trying to say now? Wait. But I'm trying to say the movement that we have, right? As much as we cap it to whatever we have for the current year, so it doesn't go over. I know this question. I think I'm just going to consult with what I want to ask because I just can't articulate myself right now.
Okay, that's fine. That's fine. I think maybe where your mind may be coming from is maybe one of two things. The one thing is you can actually think about each item individually and ask yourself, what is the movement between the plant from this year and the plant of last year, provision of this year and provision of last year? That's one way to think of it. And you can actually technically pass a journal for each and every item, but it's not necessary because you can actually just do a total and consider the balance this year and the balance last year and pass a journal to get it to the new balance. But maybe your question, might come to you a little bit later when we do the bigger example, because I'm then going to show you a few things, what it might look like at a line-by-line basis, what it might look like at an overall basis, and I will show you the journals too. So maybe it'll come a little bit better to you. If it isn't, and you are still obviously not sure, and you're thinking, but you're just not sure how to articulate, always welcome to also consult, and we can maybe chat about it then too. Okay.
Okay. Thank you.
Okay. Soka. If that is how I say it. There are 2 Ks. Do I say both of them?
No, circa is fine.
Okay.
Hi, TJ. I
Yes.
wanted to confirm in regards to the to us in cases where it's not probable that we'll make future taxable income, right? Let's say in the current year. And then comes the following year, circumstances change and we do end up making a profit. Do we expect to have a reversal of our deferred tax, or we
Very
just keep
good
it at zero?
question. That's a good question. So two things. The first thing is, next year you first do your current tax calc, where you will then look at how you are using that assessed loss, right? And you'll see what happens there. If there is still a balance left over on the assessed loss, you will take that balance to your deferred tax calculation. You'll put it here and think about it here too, right? And you ask yourself the question again from scratch. Now I am standing at, say, 31 December 2025. How do I think things are going to be now? You ask yourself the question from scratch. And then you determine, can I recognize this DT asset now or not? Even though the numbers may have shifted a little bit, your carrying amount would have changed, your tax base may or may not have changed, so your temporary difference changes as well. But now you ask yourself the question from scratch. Can I now recognize it? Do I now think I'm going to be profitable next year and the year thereafter? And then you do it all over again, you see. So think of it anew. Think of it, just ask yourself the same question as you stand now 1 year later, when you get to the deferred tax. And again, I think an overall example that we're going to do later is maybe going to make it a bit more, because we're going to look at 2 years.
Yeah,
Okay.
so that unrecognized portion, what do we then do with it? Does it just form part of a disclosure of some sort? Or
Yes, you will disclose it, and I'll explain to you how and why. But later, when we do get to the presentation and when we get to that example. So that is a very good question, because that is also where the wheels start falling off, is because we don't know what to do with the recognized and unrecognized. But we will know what to do with that now. Okay. You will see that even if you go to the other paragraph, so the one we were looking at earlier, I just want to hop back. This one we were looking at earlier from 24. From paragraph 24, was looking at a deductible temporary difference. The standard then goes and addresses a loss specifically. So technically be very important, actually weirdly important, but not really important from a technicality side. An unused tax loss is technically not a deductible temporary difference. They are not the same thing, but you treat them the same. Okay. And you will see the standard speaks of it in the same way in 2 paragraphs. They then just address the loss sides specifically, because a history of a bunch of losses is not a good sign that you're going to be profitable. So it's going to become more difficult for you to prove it than you will with a deductible. But even though they are technically 2 different things, you treat them the same way. They both will give rise to a deferred tax asset, and you will consider the same criteria. Is it probable that I'll have sufficient future taxable income, yes or no? And then if yes, recognize in full. If no, recognize to the extent. Okay, it's the same. Okay, and as I said, if you have so many unused losses, it's strong evidence you're not going to be profitable. History is going to probably repeat itself. Okay, past evidence is a good support for saying that you're probably not going to be, but it's not impossible. Okay, and so there we see the same story I gave you with the same criteria. Right. Is that a question? Maybe not. Just going to mute you. Sorry if you wanted to say something. Okay, so the criteria is the same. Okay. If I now do another example, at the end of 2024, they've calculated these temporary differences at the end of this year, okay, they had an assessed loss amounting to 5 million. Okay, which then means that I do my DT calc. They've given me this plant portion that they've calculated, and I did my current tax calc first, and my answer there, my final answer was not a taxable income, it was a loss, a tax loss of 5 million. So at the end of 2024, I have 5 million as a loss. Okay, the question is, can I recognize a DT asset on it? I want to recognize an asset that is 27% of that. That is the benefit I'm going to get in monetary terms, right? Which is 1.35 mil. Okay, which is going to, if I look at this example, take me to a net deferred tax asset of the 1350 minus the 270 is going to give me 108. Okay, but we have the same question to ask. Will there be sufficient, is it probable that there'll be sufficient future taxable income against which I can actually use the assessed loss? If it is probable, I will do what I wanted to do. Recognize the DT asset in full. If it is not probable, I have to limit it to the taxable temporary difference. Okay, which means I get to a 0. So it's exactly the same scenario we had as with a deductible temporary difference. So a deductible temporary difference is coming from my SFP items, provisions, anything, even it's not just limited to a provision. A provision is a good example of it, but sometimes even an asset can result in it if you are writing it off faster for accounting purposes than tax. Okay, if your tax base is higher than your carrying amount, you'll still get a deductible temporary difference. Okay. Are we sort of comfortable with it? We are going to do a big example that we're going to do the assessed loss across 2 years again.
I just had one small question. So if our taxable temporary difference, right, was 0, does that mean that our deferred tax asset would also be 0?
Correct. If it's
Okay.
not probable, then you can recognize nothing.
Okay.
Then the full item is unrecognized. Correct. And recognized from an accounting perspective means I have passed a journal for it.
Okay,
I have
so
brought it into my accounting records. Do you see that? Okay. It is not the same thing as utilized. Okay. Utilized means I have used it for tax purposes. Means SARS, I've filled out my tax return and I've used my assessed loss. That is separate to an accounting entry, but we're going to look at that too with the example. But keep in mind the difference between recognized versus utilized. They're not the same thing and they don't really, they affect each other in a way, but they're not the same thing. Okay. Because there's a common error that happens there. Okay. Measurement. Okay. How do we measure it?
Okay.
Yes.
Just a quick one. So the scenario will tell us if it's not probable or it's probable, or will there be like information that's evident that it's probable or not?
Either we're going to be very clear and say to management believes that they will be profitable in future, or we will say to management does not believe they will be profitable in future. That is as far as it sort of goes. We're not going to ask you to really make an assessment like that on your own, because it is, practically in real life, it's not an easy answer. And we can't really expect that of you in like an assessment. So it'll be quite clear to you whether it is probable or not.
Okay, thank you.
Very clear, yeah. Okay, how do we measure it? What tax rate do we use? And remember I said to you, my tax base is my future tax deductions. If we're thinking about an asset that is where the future economic benefits are taxable, right? So future tax deductions become quite important because it can also filter into your liability tax base, right? So it becomes quite important. But how do I know what that amount is? How do I measure these things? And then what rate do I use? Okay, and so what's important is you must ask yourself, how am I going to recover or settle the carrying amount of the asset and the liability? How are the future economic benefits going to come to me? Is your question. You need to ask yourself that question. Okay. As we said, an asset is your future economic benefits. So you need to ask yourself, how are those future economic benefits going to be taxed? Okay. And for liability, again, how are those cash flows going to be taxed? Okay. Which means that both your tax base and your tax rate will be influenced by how you expect to get the future economic benefits, your future cash flows. Okay. And how you're going to settle that liability. And your options essentially are, am I going to use the asset to very simple example, am I going to use it to create, manufacture inventory, and I'm going to sell the inventory and I'm going to get that money? Or am I going to sell the asset? Is it something I'm holding that I want to sell? Okay. Or is it going to be a little bit of both? Okay. The reason you need to think about these expected manners of recovery is because the tax consequences may differ. And therefore, you may have to consider, what is my tax base based on my expected manner of recovery, and what is my tax rate? Now, for us in South Africa, for a company, your tax rate's 27%, right? Except for CGT. There it is 27% times 80%. So you need to think about, is this asset going to be realized through use, or am I actually going to sell the asset instead? Okay. And that's what we're going to look at now. Okay. And furthermore, when you think of these things, the standard then goes and addresses specific types of assets and tells you it will always be so. So for an example, a non-depreciable asset that is measured on the revaluation model in IAS 16 is deemed to be recovered through sale for deferred tax purposes. You must assume it is through sale, okay, regardless of the basis of measuring the carrying amount, okay. Very common example of this is land on the revaluation model. Land is a non-depreciable asset, and if I say to you, you've chosen the revaluation model, it is deemed to then be recovered through sale. So how will the land, if I think about it, if I bought land of 500,000 as a cost, and I've bought it to sell it, how is that going to be taxed for tax purposes? There will be CGT, you agree? Okay, in which case, think about the tax base, right? It'll be my base cost because I'm dealing with CGT. So I need to ask myself, what will my base cost be? Because that is going to be my future tax deduction, because this is an asset of which the future economic benefits are taxable. Okay, and my tax rate will be the CGT rate. Do you see that? Do you see how you need to think about these things? How am I going to recover it? Okay, and as we said, the standard tells us, it prescribes and says for a non-depreciable asset on the revaluation model, it is deemed through sale. Okay. So if I say to you on 1 Jan 2025, you acquired land for 350 and you've decided to keep it on the revaluation model. Okay. Obviously, no capital allowances on the land. Now I have revalued the land to 380 at the end of the year. I bought it at the beginning and now I've revalued it. Prepare the journal entries for the above. Okay, so first of all, expected manner of recoveries through sale, as we've discussed. Future tax deductions will be base cost tax rate or be CGT rate. So my deferred tax liability or asset will be calculated as follows. Carrying amount is going to be the revalued amount of 380 because it's on the revaluation model. My tax base is going to be my base cost, which is my original cost, which was 350, which gives me a taxable temporary difference of 30. But what rate am I using? The CGT rate, not 27, but 27 times 80%. Okay. And what journals will I pass for both of these? Well, first of all, the revaluation surplus will go through OCI. And then second of all, the deferred tax must be recognized on it that I've just calculated on the previous slide. Okay. Cool. Do you see, very important, I want to show it to you there. Look where I am debiting it to. Do you see it is not sitting in income tax expense? Because previous lecture we said truck and trailer principle. There where the truck goes, that's where the trailer goes. So because the main transaction is going through OCI, the tax must go there too. Do you see there? So I can't debit P&L income tax expense. I must debit OCI. Okay. To the revaluation surplus. So I reduce it by the tax that I've just calculated. The deferred tax, in fact. Happy with this here? This example specifically.
Hi,
Hi.
sir.
Yes. You go.
So I wanted to ask, like, if this affects, they say all non-depreciable assets. So is this things like investments and intangible assets? Would they also be handled in the same way?
No. So this is very, very specific to non-depreciable assets measured on the revaluation model in IAS 16.
That's
Very specific. Do you see that? So it will be PPE that are where you have non-depreciable, but just hold on to your seat because the standard doesn't stop at that paragraph, right? We have a next one. Now we say, now it addresses investment property on the fair value model. Okay, and it says that again, there's a rebuttable presumption that it will be recovered through sale. Rebuttable being a fancy word for saying you can't prove otherwise, but it is assumed this way first. Okay, so the assumption is that any investment property, rebuttable presumption is easy to say. We are assuming that investment property on the fair value model will be recovered through sale, which means your deferred tax must go via sale. Okay, but it is rebuttable. Okay, when can you rebut it? When can you prove that point wrong and say it is not sale, it's use? Okay, if the investment property is depreciable and is held in a business model where your objective is to consume substantially all the economic benefits in the investment property over time. Okay, it's basically saying that, and now this is all, think with me conceptually about all of this. A fair value is a what value? What is the definition of fair value in IFRS? It's coming from IFRS 13, but what is the definition of fair value? Putting you on the spot.
I can read the definition.
You can read it. I will summarize it otherwise, but thanks. Thanks, though. Okay, so a fair value is for an asset, the estimated price to sort of sell it, right? For liability, it's to settle it. Okay, I'm paraphrasing this definition, okay? But the crux of it for an asset, which is what investment property is that it is a fair, because it's in an orderly transaction between market participants at the measurement date, right? So it's between unrelated people essentially, and it's orderly. So no one is being influenced here, all is well. Okay, it is fair. The value is fair between two people. And for an asset, it's basically a selling price. Do you see that? It is a fair selling price. So how are you then not? And that's where the previous one came from too, né? If we thought about this revaluation model, even though it's at a revalued amount is what we call it, how do you revalue? Do you revalue to what? Fair value. Investment property on the fair value model is recognized and reflected rather at its fair value, which is a selling price. So why are you saying then the asset is sitting at a selling price, but now you want to not have the tax to do that too? Do you see why we are making this assumption? Because you already assumed that when you selected the accounting policy. Do you see that? Now my next question is to you, what does depreciation reflect?
So it reflects us now using up the economic resources from there. So.
Yes, right? We are using it. So this presumption of it being through sale is rebutted if you are depreciating the investment property, which is possible, right? You can actually do that. Do you see what I mean? So if you are depreciating now it's starting to look like you are not recovering it through sale, you are recovering it through use. In which case now we can say, okay, you know what, it's fine. It is not assumed to be through sale. Do you see why these paragraphs exist? Does it make sense? Okay. So if it is on fair value model, investment property, assumed to be through sale unless rebutted. Okay. If it's through sale, it means CGT, right? So it's a asset. Future economic benefits are taxable because I'm going to sell it. They're going to tax me when I sell it. And they're going to tax me on the proceeds less my base cost, right? So therefore, tax base is going to be my future tax deductions. In this case, the only deduction I get is through base cost. Okay, my tax rate then would be the CGT rate. Okay, so if I say to you at the beginning of 2024, I got investment property, which is a building, for 350. Okay, I've selected the fair value model as my accounting policy in respect of this building. Okay, no capital allowances are allowed on the building. I'm telling you to assume that for now. Okay, at the end, at 31 December 2024, the building was remeasured to its fair value of 450 on this date. Prepare the journal entries. Okay, it is presumed because it is on the fair value model, it's presumed to be through sale. Thus, my tax base, which is my future tax deductions, because my future economic benefits are taxable and it is an asset, will be my base cost. The tax rate will be the CGT rate. Okay, thus I would have calculated it as follows. My carrying amount is my fair value. My tax base is my base cost because that's my future tax deduction is base cost. Okay, which gives me a temporary difference of 100 times the CGT rate. So times 27% times 80%. which is going to give me 21,600. How do I pass my journal? Okay, first of all, I'm going to do the fair value adjustment. Do you see where it is going? Do you see it is going to P&L? Do you remember when you did your foundational knowledge week or two, when we did our assets in week 1, actually, okay, we remember that PPE on the revaluation model goes through OCI or P&L, depending if it's a previous increase or decrease, but OCI focused. But investment property always goes through P&L. Always. Okay, so it is going through P&L, which means my tax is going there too. I just calculated the tax. I'm going to then debit income tax expense in P&L. Happy? Okay. Are you happy with what we did here with the rates and whatnot? Because I'm going to make it a little bit more. I'm going to do another example now that's maybe going to be a little bit more. So you need to have understood why we are using base cost and why we are using the CGT rate, because it will be recovered through sale. That economic benefit will be recovered through sale. When it was through use, I would have used my normal tax base, which would have been my future tax deductions, could have been my capital allowances. Okay, and then the rate would have been 27%. Okay. Now, I'm giving you a new example. I'm saying to you, I bought on 1 Jan 2022 a building for 22 million. It's a lot of money. Okay. I've selected the fair value model. It's investment property here. Okay. SARS allows capital allowances of 5% per annum on the cost of the building. At 31 December 2025, the building was remeasured to its fair value of 31.2 million on this date. What are the journal entries? Now, I want to share an Excel sheet because I have a little bit more steps and pictures and things to show you. I'm going to share my screen again. I'm just going to pull it up on the side quick. Okay, but I now need you to think carefully. Just want to go up, scroll up a bit. I'm sharing an Excel sheet now, which has a copy of the example in text over here at the top. Can you see the Excel sheet?
Yes.
Great.
Yes.
Now I want to ask you, if I'm getting capital allowances, but it is also on the fair value model, what now? Because some of the tax benefit is going to come from capital allowances, because I can actually claim capital allowances on it. However, the rest is going to come sort of from sale. But do you agree with me? I've selected the fair value model and I'm not depreciating it for accounting purposes. So applying that paragraph, have I rebutted that presumption? It said to me, if it's on the fair value model, it is through sale, unless it is depreciable. Now, depreciable for who? For us. We are not depreciating it. So I still expect to recover it through sale. Now I want to ask you, so that means it's through sale, which means that your tax base and your tax rate must be through sale. But just don't want you to see that yet, but it's fine. I want you to first think, what will happen when I sell it? If I have claimed allowances, what are the tax consequences when I sell an asset on which I have claimed allowances?
Recoupment.
Is there a recoupment?
Yes, there's a recoupment, you agree? Okay, there's a recoupment. And thereafter, you will do the CGT. Now, I'm sure you are all comfortable with basic CGT. Your recoupment is calculated how?
Selling price or sales value less
Tax base,
Your tax value.
tax value.
yeah.
Now I want you to picture the story here and the scenario that is my cost, right? 22. And my fair value, which is a what? Basically a selling price, do you agree? Is 31. Okay. But what is my cost? Okay, let me put this facts here. Just selling price, 31,200. Okay, and my cost was 22 mil. We're doing a little bit of tax today. Have you noticed? Okay. Selling price limited to cost. Now, of the two, I want to take 3,200, but it is limited to the cost. Do you agree?
Yes.
Okay. My tax value is my cost less allowances. Just do it like this. Okay, my cost is the 22 less allowances for FY 2022, 2023, and 2024. Do you agree? Where are we now? 2025, actually. 4 years. Happy. Because I would have claimed it in 2022 when I've bought it and brought it into use. 22, 3, 4, and 5. You agree? It is 5% per annum. Happy? You agree with me?
Yes.
Please. Excuse me. Thank you. Okay. Rapramanas, no. Sharp, which will give me my recoupment. We're doing a little bit of tax, but you will understand why, because I need you to first think about the tax before you're going to be able to do the accounting. Otherwise, if I just jump into the accounting, you're going to not enjoy your time. Your recoupment is going to be 4.4. Now, if I say this is your taxable income column, okay, you would have included it in the, so like that. Great. Now CGT is proceeds less base cost. Do you agree? Proceeds is your selling price less your recoupment. You agree? Selling price less my recoupment. Do you agree? You will do CGT in detail too. But you are happy? Okay. And base cost is cost less allowances. You agree? Which gives me a capital gain. Are you happy with what I'm doing? Okay, which you include a taxable capital gain. Which is 27%, 80%, and then your 27%, obviously, which you're going to put in your taxable income column. That one times 80%. You agree? Okay. And this one, you do what to? You now go. A bit fast today for this thing. Which is the sum of your, this is your taxable income essentially. Okay, which is the sum of your recoupment and your taxable capital gain. Which gives me my February 27%. Are you with me? I've done nothing strange yet. It's a little bit of tax revision. But do you see the problem here? When we are looking at the tax rates from a deferred tax perspective, because some of this amount is taxed at the CGT rate of 80% and some of it is taxed at the full 27%, because this is effectively me going like that. That one and that one. Do you agree? Which is now the sum is going to give me the 3. 80% times 27% and all of it times 27%. So do you see that the difference, and this is where CGT actually exists. If I say to you the fair value is the 3.12, my cost is the 22, and my tax base, okay, is actually going to be, as in accounting, think about your tax base in accounting, it's going to be the cost minus allowances claimed, normally, right? And the allowances claimed here, I've already calculated them there, so I'm going to say minus sum of those ones. Wait, what did I do now? I've double minus, ne? Okay, there we have done the correct thing. Okay, that's my tax base. Do you see that the difference between these two should then be taxed at 27%, because that will be a recoupment. A recoupment is at 27% times 100%, but it's 27%, right? We just did it. You did it with me. Okay. And then a capital gain will be taxed at 27% times 80%. Do you agree? Which gives me my DT liability. Are you with me? We did it here for tax purposes, in the tax mindset. But in accounting, a capital gain is actually a capital gain only happens when you go beyond your cost. Otherwise, you have not made a gain. Okay. That's why you need to chop off the recoupment in here first and chop off the recoupment there first, and you take out your allowances. It'll get you to the story that a capital gain is only the portion above cost, is technically a capital gain. And the portion that you've already claimed before, your previous allowances you have claimed, you are recouping. That is now the sum of my previous allowances. Because I've recouped them. I've gotten a refund from someone who bought the asset. They've refunded me for my use, and I've made a gain. Do you see that? Of 9.2, the asset really increased in value beyond its cost. That portion is now CGT, and this portion is a recoupment. Recoupment is taxed at 27%, whereas CGT is taxed at the CGT rate. Okay. How do you do this here now? Okay, you've seen the picture, you're with me. How can you illustrate it here? Simple, however you want, to be dead honest. But why it is normally done, or let's put it like this. Okay, for this one, you can put here the cost. You're splitting the balance between two items because you're going to use different rates. Okay, your tax base here is going to be, as you've calculated before, which is your cost minus allowances already claimed equals future tax deductions. Normal tax base gives you a temporary difference. And this is your recoupment portion, which is at 27%. Then your fair value portion is you're going to take the fair value minus, because your carrying amount is actually 31.2, which is at fair value. So we're going to say carrying amount actual minus the cost portion, which is going to give you the excess fair value. The tax base here is, put it as 0. Okay. Because you're not getting a deduction against the gain itself, actually. You've already gotten your deduction here, because that's your total tax base. And remember, that's also going to be your base cost. Because remember, we are still assuming it is recovered through sale. So and I want to just show it to you here as a sum. You don't have to add the numbers together, by the way, but it is good for you to check yourself. Okay. Which means my carrying amount is 31.2 because it's the fair value at the end of the year. My tax base is base cost. Okay. The temporary difference is going to be that. And here I will use the CGT rate. I just saw that that is going to happen when I calculate CGT. Okay, so this is how you can include it in your deferred tax calc. But you are sort of actually already doing all of what you've done in tax. This is a shortcut because you want to do this now, because you're not going to just have one asset in a question. You might have more. Are you with me? Now you will pass a journal entry because they did ask us for the journal entries. Okay. First of all, fair value adjustment. The investment property needs to go up. It's still sitting at its cost. Goes through P&L. The fair value adjustment is the difference between the 31200, which is its fair value at the end of the year, and its cost, because we're assuming now from the scenario, it seems as though it hasn't been fair valued before, as an example. Okay, and now I'm going to recognize the tax, which goes to P&L, truck and trailer. This is the truck. This is in fact the truck, and this is the trailer. The trailer must go with deferred tax liability, SFP. Happy. Those are your journal entries. Fine. It was a lot because I quickly did tax and then I did accounting. But I need you to just see that you already know how to do this. This is not foreign. This is just a shortcut for something you have done 1,000 times over in your life. Okay. But do you see how we said you need to consider how you're going to recover it? For investment property on the fair value model, it is presumed to be through sale, unless it is depreciable. This is not depreciable. We are not depreciating it. How is it recovered through sale? Well, because I've claimed capital allowances on it, okay, and the total capital allowances I have already claimed is the 4.4, that I'm going to be taxed on as a recoupment at 27%. The rest, which is the actual capital gain portion, I'm going to be taxed on at the CGT rate times 27% gives me the tax that is coming for me in future when I eventually sell it. I haven't sold it yet, hence it is deferred tax. It will come for me later when I sell it. Do you agree? And that is where we get here. Okay.
Okay, then I would assume if there was maybe a change in use or a change of intention, moving it out of the scope of IAS 40 maybe to a different standard, we would reverse all of this and start accounting it according to that other standard.
Potentially, but for the change in use, I think we have some slides on your change in use from in the foundational slides, but it's not heavily in psychoscope. It's sort of a light level. Okay, we can test it. That's the one thing. But to answer your question, when you are doing your deferred tax calculation, ask yourself, what do I have now in my SFP as of today, the end of the year? You would first go, if you had a change in use, you would have changed and calculated the investment property, and maybe it became PPE, and you would have calculated all the calculations, you would have passed the journals, all of that before you even thought about the tax. Now you've done all of the accounting, you then do your current tax expense calculation, finish it, then you do lastly your deferred tax calculation. And then when you get to your deferred tax calculation, you say, what is sitting on my SFP? Now it is going to be PPE in your example, if you've changed it. You are going to ask yourself, what is the carrying amount of that PPE, whatever it may be. That could be whatever, could have still actually, depending on how you changed it, etc. And then you ask yourself the same questions. How am I going to recover this PPE? I'm going to maybe use it. Great. So if it's through use, I need to think about the tax base and tax rate through use. Okay. What are the future economic benefits? And will they be taxed? Oh, maybe I'm using this building. I've now decided to move into it. I was renting it out. It was investment property, but I've now moved into the property and now I'm using it for admin purposes. Okay, now I'm using it. So I've started depreciating it too, maybe. And that means it's through use. Do you see that? And it doesn't meet any of the other paragraphs. It's not a non-depreciable. It's not on the revaluation model, etc., etc. Therefore, it's through use. So that means what is my tax base? My future tax deductions, because I will be taxed on the benefits from it. Okay. Future tax deductions will be my capital allowances. Hopefully, I will continue to claim those, but it will not be presumed through sale. So then I would actually have my carrying amount here, whatever it may be, it will be a normal calc. Okay. Tax base, future tax deductions, going to get my temporary difference, and then it would just be 27%. Okay. But what is important is you sort of think about all of this from scratch. At the end of the year, you just say, don't worry about what was happening last year so much. You only care about, you actually don't really care. You do this from scratch. You ask yourself, what is the balance of all of my assets? And do I have an assessed loss? That at this point at the end of the year. And then you consider the deferred tax consequences of that asset as it stands at the end of the year. Don't care about what happened last year, because maybe now you will have whatever it is here. And let's say you end up here and you have a DT liability of 1 million for the PPE that used to be investment property. That is not, that's one extra zero. Wish my bank account had one of those. Then you'll calculate a movement. and you'll fix the balance to where it needs to be. So in effect, you are reversing, correct? In effect, but don't worry too much about thinking about, how am I reversing it? How am I reversing it? What am I doing? Just ask yourself the normal questions, and then you get a closing sort of balance for deferred tax asset or liability, and you pass the journal to move it to there, and you are done. Okay, don't mingle too many things with each other in case it might, confuse you. When is it a deferred tax asset and when is it a liability? Very good question. Okay. A debit here is an asset and a credit here is a liability. If it is a plus in this calculation, it's a liability. If it is a minus, it is an asset. Okay. Because you're going to base that assessment or that thought on the temporary difference. Is the temporary difference taxable or deductible? If it is a plus, it is taxable, which means it's a liability. If it is a minus, it is deductible, which means it will give rise to a deferred tax asset. Are you with me? Okay. Great. There is no live TUT today, and we are not done. But what I'm going to do before we do this example, it's going to take a little while, but not too long. Maybe a quick 10-minute break. Then we will do an example. Won't be very long, but I want us to just work through it carefully and fresh. Okay, processing all of this. And then after that, we will be done for the evening. And then after that example, you can go and watch the pre-recorded tutorial. The trainees are just at SAICA today and tomorrow. So they are out this week out of office because they are training with SAICA. Okay. But I want us to just take some time to work through this example. So I'm going to give you a 10-minute break. Is that fine?
Sorry, TJ.
Yes.
So obviously the example that we just done now, it was a upward revaluation movement. Would there be cases where we revalue down?
Yes. Yes. If that's the case, right? And I don't think we would really, we could test it, but it is possible. But what happens if that happens? What happens if the value of an asset drops below? Okay, you will very likely scrap it. So the benefit of that, which will become a deductible temporary difference and not a taxable one, that benefit will then also be at 27%. Because if you qualify for it, which you normally do, there are only very few instances where you don't qualify for scrapping allowance. But you normally would, and you would elect to apply it because it's also, you have to elect to apply a scrapping allowance, but almost everyone would. The only time you really wouldn't do a scrapping allowance is if you have a lot of capital gains that you actually want to knock off for some reason and that are sort of trapped in there that you want to get rid of. But most people want to do an 11-0, but really you might not elect it and rather take it as a capital loss. But I don't think we're going to go that level of integration to make you think that far across both modules.
All right, thanks.
Cool. Kuhle? Oh, okay. Quick break for about 10 minutes and then we will do the example. Okay. And my face. Cool. Can you see my screen and hear me and see my face and everything? Okay. I hope everyone is back. Okay, so if I give you this scenario now we're going to do a little bit more of a broader example covering a lot of things, and I'm going to show you how it flows into the presentation and disclosure. Okay, cool. So we have 2 financial years here, 2024 and 2025. The current year is 2025. And I say to you, what happened last year in 2024 is that we had the following assets at the end of last year: PPE with a carrying amount of 1.6, okay, and investment property with a carrying amount of 2.7 and an original cost of 2.5. Okay, so investment properties on the fair value model. Okay, and the following expenses I've calculated for you: the depreciation, and I've given you the capital allowances for last year. Okay, that we already did. And on the fair value model, and now I've given you the deferred tax calculation already done for last year. Carrying amount, tax base, I've calculated it for you, temporary difference there, and carrying amounts, fair value, tax base is original cost. Okay, CGT rate, because fair value model assumed through sale, gave me a DT liability last year of 151,200. But I said to you as well, at the end of last year, you had an assessed loss of 1.2 million. Okay, and I've told you that at the end of 2024, the directors were not sure whether you will be profitable in future. What did that mean?
That you might not be able to use the entire thing. Assess
To
loss.
recognize the entire assessed loss. The DT could be 0, depends, and we're going to see. Okay, and we're going to think about that soon. Okay, and then I gave you the information for 2025. Okay, now we said in 2025, we made a profit before tax. This is an accounting profit before tax of 1.7. And I recognized depreciation, claimed capital allowances. I've expensed some fines, and I've earned some dividend income. And I've revalued my fair value again to a new fair value of 2.8. Okay, it was 2.7 last year. Okay, now I'm telling you, prepare the income tax expense note. Okay, an income tax expense note will look as follows, right? You'll have your major components. First of all, you're going to have the entity's name, notes for the year ended 31 December 2025, the name of the note, and you're going to say major components of income tax expense, which will be your current tax for the current year, and your deferred tax movement, which gives you your income tax expense. Okay. Right. Then you need to include a tax reconciliation, either via a tax rate or in rand values. Why do you need to do that? It is because your user is going to do the following thing. They are going to take the profit before tax, which is your accounting profit, and they're going to multiply it by 27%. And they will then expect that your income tax expense in your statement of profit or loss and other comprehensive income should be this amount. That's what they think it will be, but it won't always be. You need to make an adjustment. Okay. Cool. Right. And you need to, will it always look the same? Will the note always look the same? Not necessarily. Okay, you can work through, I have a few extra slides on, reconciling items or, and what the disclosure and everything should be that you can work through in your own time, but we're sort of going to cover all of it here. Other things that could also be in here could be foreign tax that you may show separately, but but most of the time, this is most of what you're going to see. What's going to be sitting here in your reconciliation may differ. That's going to depend on what you have in your scenario. Okay. Cool. So what numbers do we need? We need the current tax expense. We need the deferred tax movement. So we're going to do those calculations. Okay. First of all, if we think about what happened last year, I'm just going to first think about that. We discussed it and we said your DT will be 0. Why? Is because I had, if you go back to the information, at the end of 2024, I had an assessed loss of 1.2 million. Okay. I want to recognize a DT asset of 27% of that. Okay. But I wasn't sure, as they said here, the directors were unsure that you'll be profitable. Therefore, it must be limited to my taxable temporary differences. Okay, so I can't recognize the full 324. I have to only recognize 151, which takes me to a net balance of 0 at the end of last year. Okay. That means I wanted to do 324. I only recognized 151 over there, which means there's an unrecognized portion of 172,800. Okay, this gross here I'm just showing doesn't mean that it is gross. It means that it is the total before the tax. That's the full assessed loss. If you had to gross it up, it would have been 560. Okay, and the 640 is the unrecognized portion. Okay, the first thing you do, okay, this is just illustrative. You don't have to do all of this because I've already done the calc for you. I'm just showing you what did happen last year. But the required asked me for the note for 2025. So in order for me to do that, I need to get the current tax expense. How do I do it? We've covered this in the previous lecture and a little bit in this one when we look at the loss. You start with your profit before tax and you make your adjustments. Okay. They told us here what are the expenses that have been incurred and claimed, etc. We've claimed or expense depreciation and claimed capital allowances. Now, depreciation is an accounting number. The tax version of that is the capital allowance. So I'm going to add back the depreciation and I'm going to deduct my capital allowances. Okay. Then dividends was included as income in here, but it's fully exempt in terms of section 10(1)(k). It's local dividends, which means for taxable income purposes, it should not have been in there, so I must remove it. Okay. Then the fine we know is a prohibited deduction, which I've included as an expense. It reduced my PBT, was an expense that I must add back to get to taxable income. That's my objective, right? Okay. And then investment property was adjusted to 2.8 from 2.7. So I have a fair value adjustment. It was income because it went up from 2.7 to 2.8, which means I passed a journal entry that said debit investment property, credit fair value adjustment P&L, and I included it in there. But SARS doesn't care about a fair value adjustment. They will tax it when I sell it. Do you agree? That gives me a taxable income before the assessed loss of 1.403. Okay. Now I want to consider my assessed loss. Can I deduct it or not? What does section 20 tell me? Section 20 for a company says the assessed loss, the balance of assessed loss you've brought forward from last year can be deducted, but from the taxable income, but it's limited to the higher of 80% of the taxable income before and 1 million. Okay. You agree? My question, though, to you is, before I even think about the limit, what is the balance of the assessed loss? Is it 1.2 or is it 640? And don't answer. I'm going to do a quick poll, a very quick poll. Okay, I want to remind you of the scenario here. At the end of last year, we had an assessed loss of 1.2. Here's my deferred tax. Okay. I just want to see where you guys are at with this one. I won't know who said what. So what is the balance of the assessed loss? That I'm going to consider to deduct here. I have caught everyone so far but one. Okay. And that I knew was going to happen. Right. And I'm glad. This here that I am doing right now, it's a tax calculation. This has nothing to do with accounting yet. I will only do accounting when I get here. Do you agree? This is tax. In the tax paper, I will ask you the same question. All of this you will still do in the tax paper for tax exam. The fact that you've recognized something for deferred tax purposes or not was an accounting question. That was whether you've passed the journal and for what amount. SARS does not care about your journals. This is you filling out a tax return up until here. I'll make it blue. That is a tax return. Remember I said to you in the previous lecture, I said you must put on your tax hat. What is the tax framework in tax? You must start with profit before tax and make your debit and credit adjustments to get to your taxable income. This is not accounting, you see. This is all still tax. So SARS last left you and you last left them. When you finished your calculation for 2024, your final answer was 1.2. Do you agree? So that's what we're going to consider here. We're going to consider the 1.2, but it is limited to the greater of, I'm putting it over here, 80% of your taxable income before and 1 million. Okay. In this case, that's the limit is the higher of the two. So I can't use the full 1.2. I can only now use the limit, which is 80% of that. Takes me to my taxable income, and I then calculate my current tax expense. I filled out my return on e-filing. Up until here. I'm done with SARS. Do you agree? This is a return on e-filing, simulated now. Now, I will pass a journal entry. My journal will be debit, income, tax, expense, P&L, credit, current tax payable. SFP, you can also say SARS liability. You can call it what you want to call it. And that journal is going to be this amount that I've taken from my return. And I will put it here in the note as well for disclosure purposes. There it goes into the GL. Here it comes into the financial statements. Okay, happy. The fact that I've passed the journal does not mean anything to SARS when I am doing my taxable income. Okay. It means something to your financial statements, but it doesn't mean anything to SARS at this point. Are you with me? Now I will continue to do the accounting. So after this point, I start doing the accounting. I'm actually going to bring my journals in here. And the accounting will make here green. There's the accounting for the current tax. You see. And this here is all accounting as well. This was tax only. Okay, you thought a little bit about accounting when you had to calculate the fair value adjustment, but that's the same thing you will put in your tax return. Are you with me on this? It's very important. Many people get this wrong all the time. PGDA students especially. Great. Okay. Now I'm doing my deferred tax. I've passed my accounting journal based on my tax return. Now I go and do my deferred tax. Okay, I'll calculate my carrying amount. Okay, which is quite easy. They gave me last year's balance, 1.6. They told me I've depreciated 200. So it's 1.6 minus 200. My tax base I can calculate easy as well because we had our future tax deductions last year of 1.2. I've claimed capital allowance of 400 this year. Thus, my future tax deductions are 800. Gives me my temporary difference. This will be through use because it's PPE that I'm using, times 27%. Investment property, my balance is 2.8 because it's on the fair value model. Do you agree? Okay. My tax base, remember now, it will be recovered through sale because it's on the fair value model. That means I need to consider again, future taxable benefits or future economic benefits will be taxed. Thus, tax base is future tax deductions recovered through sale, which is base cost. Base cost is my original cost, which they gave me up here. There. Okay, gives me a temporary difference. Because it's recovered through sale, it'll be a CGT problem. So I use my CGT rate, which gives me taxable temporary differences of 226,800. I want to recognize DT liability. But my question to you now is, there's an assessed loss. What is the balance of assessed loss now? Well, I had 1.2 tax only. I had 1.2 that I brought forward from 2024 to 2025. I have used 1.122 in my tax return, which means in terms of section 20 only, has nothing to do with accounting. My balance that I get to carry forward to next year, again, to 2026, is 77,600. Okay, I want to recognize the tax effect of that as a DT asset. I need to ask myself a question. Will there be sufficient future taxable income? Well, they didn't actually say here, but it's because it didn't matter what my answer was, because that is much higher than that one. So I can recognize a DT asset of 20952. Gives me a net DT liability. I now need to pass a journal entry. Okay. Debit income tax expense P&L. Because none of these items went through OCI. You can see both of those are P&L items, so I can actually just think P&L, don't have to worry about OCI. Credit, deferred tax liability, SFP. My balance now is that last year it was what? So I need to get the movement, right? I need to get the balance to be 205. What is the opening balance? 0. And the closing balance is 205. So I need to get my balance to that. So it's that one minus last year's balance. Just want to make that a credit. Okay. And that will be my journal entry. Are you with me so far? Okay, I will now go and put that as a deferred tax expense and expense. 2 expenses takes me to my income tax expense. Now, when I do my SPLOCKY, it's going to be revenue, cost of sales, gross profit, blah, 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 blah. And I get to profit before income taxes, IFRS 18 compliant. Income tax expense in my income taxes category, and the amount will be that amount. Do you agree? That gives me profit for the year. That amount here is that. They gave it to me. Okay, that's my profit for the year. This is what my SPLOCKY would look like. You agree? Okay, my user is reading this statement now, and they are going, but wait, why when I go like this, am I seeing this number, but you are showing me this number? Okay, that's problematic. Why is this happening? And that's how we explain to them. We say to the user, do not worry, calm down, go to the notes. And I put here note 12. I say, go to note 12. I will tell you why that is so. Okay, so go to note 12. They then travel here to note 12. They see here, okay, some of it's current, some of it's deferred. Great, I'm still getting there. How did you get there? If I go and I do that, and now you're going to explain it to them. Okay. I see before I continue in that part, I have a question here. The 5% allowance was only on PPE. In this scenario, yes. So from the facts here, there were no capital allowances. See, they said here on the PPE, there were no capital allowances or depreciation on the investment property in this example. I don't want to shake you a little bit too much now. Happy. Great. Now we need to explain to them, but the first question is, what are we trying to achieve? I just told you that we must go then from this number to that number. How do we get there? What caused the difference? That's the question we need to ask ourselves. Why is that number not the same as that number? No. Many types of things can do it. Some universities might say to you, and it's not wrong, but it's one of the items, it is as a result of permanent differences. Now, why is this thing saying it is not being recorded? I don't know why that is happening. Because it is. It's strange. But I will continue. Hopefully all is well. Sorry. I'm just making sure it is recording. Great. Cool. So why is the difference? Some of it you can say is from a permanent difference, meaning what is a permanent difference? When they say permanent differences, what does that mean? It means it is a difference between your accounting profit and your taxable income that will forever be a difference. That'll always be a difference. Okay? Meaning that the two will never coincide. Why a permanent difference? Because there's no current tax impact on it, or you've adjusted it for current tax, but you've not then gone and created a deferred tax consequence for it as well. Meaning you've made only the adjustment here in your current tax calculation, but you made no provision for it in deferred tax. That means it's permanent. Because when you did your current tax calc, you took your profit before tax and you've made adjustments to it. For some things are permanent and some are deferred. So what is permanent here from this calculation? The dividends, right? SARS is never going to tax you on that for current tax purposes, right? So there will be no deferred tax, and there's also no current tax on it. That is then a permanent difference. It's always different between the two. With fines, it is the same. You will never get the deduction, not today and not tomorrow. So today, in current tax, you need to adjust it out, and you're not going to account for it under deferred tax either. There's no deferred tax here. It has changed now, and it will be so forever. Okay? Do you see that on those two? Okay. But that's not all that is different between the two. That's not going to be sufficient. It's not going to get me to my answer. I will put them here so long for you. Okay, this is the tax effect of it. How do I put them in my recon? When is it a plus and when is it a minus? Let's think about what are we achieving and doing here. In this amount, sitting in there is dividends of 2,000. Okay. That the user has now multiplied by 27%. There's a 2,000 sitting there as an income that they have gone and said we will be taxed 27% on it. But that is a lie, which means that in this amount is sitting this 540 that we must take out. Do you see that? We must reduce. Okay. And so too with the fine. In there, I had an expense that reduced my accounting profit, that the user went and said, I'm going to get a tax deduction of 27% when they got to this number. In there is the deduction, which is not true. We didn't get a deduction for it. We must add the tax effect of it back because it will increase my tax from there to get to there. Okay. What else is different? The fair value adjustment. But it's not a permanent difference, is it? Some of it might be, and I'm going to show you what part is permanent. Okay. Because they will tax me eventually on this fair value movements when I sell. So there is a deferred portion here. Because it's deferred, I will be taxed on the fair value adjustment later. And I've taken that deferred tax consequence into account here when I did my deferred tax calculation. I've calculated how will they tax me on that fair value adjustment in future. But the problem is here that when I did my deferred tax calculation, I taxed it at a rate of 27 times 80%, which is the 21.6% tax rate here. What did the user do? Okay, the user went and said, of that fair value adjustment, I'm going to multiply it by 27%. So the fair value adjustment is included here as income, and they went and said 27%. But I didn't account for it at 27% in my deferred tax because I adjusted it out here, yes, and then I added it back here, but at 80%. So they went and put 27% there. I went and put that. Okay, which means that we have a difference here of 5,400. Do you see that? They put the tax too high at 27. It's only going to be 80%. So I need to take it down. From there, I must take it down. Do you agree? They did that. I'm doing this in deferred tax. So I must bring it down. Okay. There's one last one. So that one we've now addressed in deferred tax. What about these two? Will it cause a reconciling item? Depreciation and capital allowances. Because in my current tax, I did adjust for it at 200. Okay. But what happened in deferred tax on that PPE? Okay. What happened there? Even though I made the adjustment in current tax, I recognized this was deferred. This is not a permanent difference. It's a temporary difference. Do you remember from the previous lecture? We did a temporary difference and we did that quick example in Excel showing how they eventually get to the same place, which makes it a temporary difference. I have actually accounted for the difference here. Can I prove it to you? Deferred tax in my income tax expense is my movement because this is a balance. What is my movement? Okay, 54 at a gross is the 200, which is that. It is a minus on the current tax and a plus on the deferred tax, which takes me to 0. Now, if you're not with me, I will get you with me soon. Just hold on to that. But the point is, it is not a permanent difference. It's a temporary difference. I've accounted for it on both here and in deferred tax. I've accounted for the current tax impact here by reversing and deducting, and then I've accounted for the deferred tax here. Okay, my last problem is this friend here. And this is where you must focus. Okay. Remember now, at the end of last year, I had wanted to recognize 324. I only recognized 151,200, which meant that I have an unrecognized portion of 172,800. Do you realize that when I passed the journal last year, now I want to tell you that you can technically pass a journal for all of these ones individually, but don't waste your time doing that. So I'm doing a shorthand here. I did a journal there for the movement in that, the movement in that, and the movement in that. Okay, so if it comes to this one here, I've technically passed a journal. Debit DT asset, credit income tax expense last year of this amount for the DT asset side for this amount, but not for the rest of the 172,800. I didn't journalize it. I put it aside and said it is not going to be journalized. Okay. But do you see that here I have taken it into account in current tax this year? So last year I didn't pass a journal. I passed a journal, but it was smaller. Now a portion of this total 1.2 came through in the current tax. Here I've recognized. And you remember that I have recognized only that, and then the rest that was left over after I did that, I also recognized here, which means that I've recognized and passed a journal this year for all of it. Some of it went through current tax, some of it went through deferred tax. But now I've recognized, either via current tax or deferred tax, the full 1.2. Are you with me? Okay.
So I think you just heard me. If you could just repeat like the last 3-4 sentences before we just jump to the assessed loss. But I
Okay.
think you almost have me.
Okay. If you think about it, last year I passed this journal to recognize the liability. Now I have technically done the following. Debit income tax, actually no. Debit current tax payable or liability, whatever you want to call it. Credit income tax expense, I'm just not typing it out now for sake of time. And effectively, I've passed this journal, which takes into account everything I did here at the top. You agree? So if I had to pretend as if I passed the journal for each item, which I do not do, it's going to be a waste of time. But if I had to pass a journal for it, I would have effectively gone and said, I'm going to reduce my current tax by this amount. Actually, that one needs to be the minus. So like that. Okay, I've effectively done the tax effect of it there. And then over here, I've passed the new journal here. The asset, credit, income tax expense, P&L. But what would the journal have been for the assessed loss though? Is it this amount or is it the movement? Deferred tax here will be the movement, don't you think? So it's going to be this year's balance minus last year's balance, which is the movement. Okay. But the point is, I've recognized all of it at this point. Okay. Okay. If the journals aren't working with you, just think about what the effect is, because I'm going to show it to you in another way soon. Okay. But what has happened is, and this is what I want you to focus on, is this assessed loss is now hitting this line item here twice, once on the current tax and once on the deferred tax side. Okay. And actually, if you look at what I'm adding here together, if I'm having my sums here right, I want to actually do it this way around. Let's do it on the P&L side. That doesn't look right, does it? Seems wrong. Okay, because we think we want this one. Okay. And that's essentially causing a bit of the problem. Okay. But what's happening is I am hitting my income tax expense with something that is not sitting in here, and that has sort of suddenly appeared. Now, to explain the assessed loss to you and all of what I just did, I'm going to summarize it for you here at the bottom. Now, what we said was, and you must work with me, the income tax expense is the sum of my current tax and my deferred tax movement. That gives me my income tax expense. Okay. I am going to show to you how these adjustments flowed into my current and my deferred tax, because eventually I need to get to my income tax expense. Okay. The user has done what? They have gone and said, surely I will take my accounting profit of 1.7, multiply that by 27%, and that should give me what I expect. However, when I calculated income tax expense here, it is 281. And I'm going to show you how the reconciling differences are happening and why. It's because there is a mismatch between what's happening in accounting profit, what's happening in, income tax expense, and the sum of income tax expense always is your current and your deferred tax. Now, these two numbers I am borrowing from up here. We've done those calculations. Okay. And I want to show to you, if you go and you actually just think about everything that impacts my current tax between accounting profit and current tax expense, as well as everything that impacts my deferred tax, which is all of my assets, here they are, including my assessed loss. Let's think about the impacts of them. Now, this was easy. I've copied all of that from here. I've gone from a profit before tax to taxable income. You see that? I've copied them across and I've told you what these items are. What is the current tax impact of each of those items? It's going to be the 27%, because that's what I did here. Effectively, by me just going, I've effectively taken each item 27%. Okay, that got me to current tax. This is just your current tax calc. You agree with me? I've just illustrated it a little bit summarized. Okay. Deferred tax on PPE was what? It was the movement. So if I look at the movement, it's this year's balance, 2025 balance, minus last year's balance, which gives me an increase of 54. Okay, that's what I'm putting in here. Do you see that? This is the tax effect of those two adjustments. So this is actually just one item, if you think about it. They have actually reconciled across. Because those two put together is minus 54. That one is a plus 54, so it gives me, I've accounted for it on both sides, essentially. I've accounted for it in current tax, and I've accounted for it in deferred tax. Because it's actually just a deferred implication. It's not a permanent difference, it's deferred. Okay. On the dividends and fines, there is no deferred tax. Because there's no asset, nothing funny happening. So that causes a bit of a problem. I've summed here. This column is summing everything. Okay. On the fair value adjustment, I've already illustrated this part for you. On the current tax, I accounted for the 27%. In deferred tax, I've accounted for the movement. This year's balance minus last year's balance, which gives me 21,600. That is exactly what I showed you earlier. That's your movement, which gives you your reconciling item. Now, lastly, my assessed loss, I've accounted for 27% of it here, of that amount. In my deferred tax, I had this movement between the two. Okay. And that difference here, I was supposed to minus the 1. Okay. That difference here is giving me what? Doesn't that number look quite familiar? It's the unrecognized portion that is now being recognized. Okay. That 172,800. Okay. I am recognizing a little bit in here and a little bit in there. You see that? because I am actually reducing my current tax by this amount in total, and I am also reducing my deferred tax by 20952. So that is causing all of my, these are my reconciling items. That's what's going to have to be in your recon. And that's what we will have here. The only complication with the assess loss is the standard asks you to clarify to them. By the way, the sum of these two is going to be that, which is your unrecognized portion from last year. Okay. There's a portion that is reducing deferred tax that was not recognized last year. Okay. And then there's a portion that is reducing your current tax of the 172. Okay. Of that, we've now continued to recognize 20952, which is reducing the deferred tax, and the rest would have actually flowed in here in your current tax, which gives me my total unrecognized portion. So we're essentially saying to the user, listen, you are not accounting for the fact that I didn't take into account this 172,800 last year. You're not accounting for it when you are doing this thing. But it's coming through in here, a little bit there and a little bit there. And I am now saying to you, where did it come from? Here. A little bit went, most of it current tax, the rest went to deferred tax. Okay. Because if you think about it, of this amount, I did recognize from a deferred tax perspective 151,200, not just the tax effect of that one. Okay, so I've already recognized that portion. Okay. And that is sort of what's showing me is reducing my current tax. So it's this 172 is coming through in here for the first time into my records, and the rest of it is going to deferred tax. You see that? Have I lost you? And now I'm getting to those two numbers being the same. They must be the same. That's the point. Crickets. Lebogang, have I lost you or are you with me? Is the yes for lost or the yes for you are with me?
I'm with you, TJ, but I'm a bit lost. But I think I'll just go through the question paper and just try to align from there.
Okay, but where are you lost? Because you are probably not alone.
Okay, so for me, I think I'm still catching up. So yeah, I'll probably just need to go through the theoretical part and just
Okay,
align
that's
with
fine.
question papers just to combine the two.
Okay, that's fine. Okay. Cool. But the best way to think, oh, you go.
Hi, sir. No, I wanted you to scroll down to, I think one of the assessed losses, one of the balances before, with now the unrecognized portion. And yeah, no, I'm just trying to get the calculation right. So, we recognize it in the 1 year, but then it's limited because of now the uncertainty.
Yes.
So that we have a little bit left over, the 172, right?
Yes, that
And
we
then in the
didn't
next year,
recognize.
when we are now allowed to utilize most of it, which we do in the, yes, in that now, that's 75. I know, not the 75, the 151 of
Yes, so the
the
one,
assessed loss.
yes. So the 151 is essentially, if you think about it, this here is the 27%. But some of this amount I already accounted for last year under deferred tax. Do you agree? Some of this 303.
Yes.
Do you agree? I accounted for 151,200 of the 303 that is now being taken into account here. I've already accounted for it correctly
Yeah.
last year. Do you
Oh,
see that?
yeah. Yes, yes.
So that means that the rest of it, the 151,200 minus the 303, this is now being accounted for the first time this year. Maybe I
Oh, okay.
should.
So then that's
Maybe
what
I
gives you
should.
the 2952.
The 29.
Which is the now part of the portion that you net off against the deferred tax liability in the second year.
So maybe if you, I'm just going to do that. So if you think about it like this, maybe I must just swap these numbers too. Put that one at the top, put that one there. Okay. Do you see that? I'm accounting for the assessed loss in my current tax expense at 27% of it, obviously, because of 27% of the deduction, after the deduction. Do you agree?
Yes, sir.
Okay. Last year, I need to swap these two as well. Okay. Last year, I already accounted for 151,200 in deferred tax.
Mm-hmm.
Of this 303, I already accounted for it last year. But this portion I did not account for last year because I couldn't. Not because I was wrong, I was right not to do it, but I couldn't do it because I wasn't sure if this was going to be a good year.
Yes, sir.
And that's essentially the difference between those two, saying, I've now this year, I've taken into account 303. Of the 303, 151,200 I already did last year as part of deferred tax. This is new. It sort of fell out of the sky. If you think about it, it existed, but I couldn't account for it. But now I have accounted for it. Now remember this journal I showed you here, debit, current tax payable, credit, income tax expense, because it's reducing my income tax expense. You agree? If you had to think of it that way. I'm accounting for it in full now, but it means that a part of it I already did under deferred tax last year, and a part of it is new this year, which is this unrecognized portion. You see that?
Yes, no, I definitely do. So I think I'm getting there, but yeah, no, it
Okay.
definitely
It
makes
does.
no sense.
It is not an easy thing. The stuff is usually quite tough. There are people. I remember. I'll always remember this. When I was at PwC, they had, and they hope probably still have it. They had like a third year graduation for the third year training when they finish sort of their articles in like November or something. And then they do like a little thing and they give you a little paper and whatnot, but they put a quote or something. And the one person who is now obviously a CA and at that time had finished qualifying, her quote was, I still do not understand deferred taxes. And I relate with that. It is very confusing, but you have to just take some time to sit with it and you will understand it. Okay, because it is, you can see how I'm going crazier on the sheet with calculations and numbers popping out everywhere. But it does make sense when you get there, but it is going to take, I can only sort of do as much as I'm doing here, but some of the
Understand.
thinking is going to come from you playing with it. And that's the benefit of me giving you this sheet, because you can then go and play around with the numbers. And I can actually show to you one last thing. Hopefully this does not make everything even worse. But if I remember, I said, what if this was not true? What if we said that there is certainty? This would then have been that, you agree, the full amount, which means there was no unrecognized portion. But that then means there should be no reconciling item, because I've recognized it in current tax, but I've already accounted for it last year in deferred tax. So my movement here is the same as my movement in my current tax. So this reconciling story with an assessed loss happens if you have an unrecognized portion, either, very important, in the current year, or one that was unrecognized last year that you are now recognizing this year. So any unrecognized portion last year or this year is going to cause a reconciling item. So if you recognized all of it, you would have had no problem. These calculations are now netting off, so you actually should not have anything. Because there's no problem. We recognized all of it last year as deferred tax. This year, voila, most of it is coming through in current tax. Our expectation as an asset last year has realized this year. But now, if I go back to what it was, is sort of my expectation as an asset last year when I've recognized the deferred tax asset was lower than the true scenario of this year. You see, this year's scenario is much more positive than I expected. My tax is reducing way more than I told my users last year that it would be. I told them your tax benefit that is coming is 151,200. But magically the next year it was 303. Do you see that now? That means that this expense is going to be much lower than they expected it to be. And that expectation is then the difference between the two. And that's why I have to minus here. Because they didn't realize that there is secretly a 172,800 that fell out of the sky. It existed, but I couldn't tell them about it. In the numbers last year. Do you see that? And so because it has become, in the actual fact, it turned out that I'm getting all of it now. I'm getting a lot of benefits now, of which I only accounted a little bit of it. So now things are looking up. So because I've essentially recognized more this year than I told them about last year, I didn't account for enough of it last year. It's going to take that tax much lower than they thought it would be. That's another way of thinking about it. Fine.
Okay, so no, thank you, sir. I think, yeah, it'll take time, but I'll definitely.
It will take time, it will take some thinking, and it will take some examples. It's something that people don't figure out for many, many years, because it's just a lot. But you are fine and you will be fine. It does take time, but you just need to sit with it, that's all. Okay, that is it sort of from me. I just want to check. Look, we don't have any more time. So you will see I'm going to flip through them and show you. I think you can see slides now. It's sort of just going to show you here very easy things that you can work through. Okay, very simple stuff. It's all disclosure, offsetting, etc. Tax recon, everything I've already told you now in this example. These are just examples of things that may cause a reconciling item, but we've touched on what is going to cause it. Okay, and another way to think about it for these sort of items is to say the user has applied a rate of 27%. We are applying 0%, 0%, and 80% instead of 100 of the 27. So it's things that you have applied a different tax rate to now and in the future. But that's another way of thinking of these things. There are many different ways, but you will get there. Okay, so that is it from me. It is going to take you some time to get used to it. Don't get scared. You will be fine. You can do it. And we have taken quite a lot of time to sort of work through it. So what you now need to do is to just watch the tutorial video. You can obviously do it now. You can do it a little bit later. The pre-recorded video of the TUT for last week, obviously. And then you can do the concept test, and then you can attempt the TUTs for this week. And yes, you will be fine. But as always, I have my slides and I close them. As always, I think I'm still sharing my screen. You know where to find